crude oil market is still reeling from the effect of the escalating crisis in Iraq and looming political tensions between the United States and Iran. Despite some profit-taking earlier on, Brent crude futures were still at $57.82 per barrel in early trade, which is almost a third above mid-year levels. U.S. crude futures were at $51.78 per barrel, and that's almost a quarter above mid-June levels. The higher prices come as Iraqi government forces captured the major Kurdish-held oil city of Kirkuk on Monday, responding to a Kurdish independence referendum, where there were also reports that Kurds had shut down some 350,000 barrels per day of production from major fields in Bahr Essaam and Havana due to security concerns. And for more on happenings in the crude oil market, let's talk to a research analyst at the financial derivatives company, Damilare Adeshola. Thanks for joining us, Damilare. So we see oil prices are gradually approaching $60 per barrel. Haven't stayed above $55 per barrel in the last 4 weeks. What are the driving forces behind this price rally, apart from the effect of the escalating geopolitical tensions?
Well, so the oil market is really just responding to the ongoing tensions in the Middle East, as well as the tensions between the U.S. and Iran. But apart from that, we've also seen a boost in the Chinese import demand, and also there's been a decline in rig count. So all these factors are really just what is driving prices up, and we early this morning came to about 58.6, which is almost a year high, and so we just continue to see these prices push up higher and higher as these factors continue to play. But primarily at the moment is really just the ongoing geopolitical tensions in Iraq, as well as that between the U.S. and Iran.
So is this a blip, or should we expect the bullish trend to persist? Just give us an outlook on oil prices for the short to the medium term.
Well, so primarily the market is responding to the increase in the risk. So the risk associated with, so for example, with the U.S. and the Iran, the tensions going on with them, there's a possibility that the U.S. might reintroduce sanctions. And so we're looking at a possible 1 million barrels of Iran exports of oil being cut off from the market. And then looking at Iraq as well, with the city of Kirkuk, it has a capacity of about 500,000 barrels. So once, if the possibility of these, so a total of 1.5 million barrels being removed from the market is what the market is responding to, as it were. So if we see a decline in global supply, that then it just follows that prices will be pushed up. So the possibility of because now the Iraq government has regained control of the city of Kirkuk. So we see that as a statement was issued from Baghdad saying that all operations will continue as normal. So we expect that in the short term in Iraq, we expect that everything will be sorted and the issues will be resolved. But regarding the U.S. and Iran, the Congress has about 60 days to decide what it is going to do, and so we're just waiting. The jury's out into what they're going to decide to do.
Now let's bring things closer to us here in Nigeria. We've seen oil production standing at 1.86 million barrels per day in September, and that's despite OPEC's cap at 1.8 million barrels per day. Do you see oil production reaching the budget benchmark of 2.2 million barrels per day?
Well, first of all, the official OPEC reports do not include the condensate. At the moment, the condensate are about 400,000 barrels per day. So if you add that 400,000 barrels to the 1.86, which are the official levels of production, we would get about 2.26. But we expect that due to the stability in the oil-producing region, Niger Delta, we expect that production will continue to persist at current levels. But a consideration of the government and the oil authorities will be the possibility of a cut. So if Nigeria continues to increase production and there's continues to be a production rally, there's a possibility that in the OPEC meeting in November 30th in Vienna, there's a possibility that we would be included in the cuts for 2018. So that is also something that the authorities will be considering as they continue to increase domestic production.
So, Damilare, it seems Nigeria is in a good place with higher production and higher prices. What are the implications of this for the commodities market and the domestic economy at large?
Well, the major implication for this is the increase in forex. So we know that all revenues contribute a very significant portion of forex earnings to Nigeria. So we expect that there would be an increase in forex availability, and also this would reduce the pressure on the naira. That being said, the impact on commodities market would be that for our imports such as wheat and corn, we would see that importers would be getting it for cheap. Now, we don't know how long it would take. Usually there's a time lag between when costs reduce and then when this is reflected in prices. So in the medium term, we could see this being translated to lower prices, and we could see commodity prices coming down, commodity prices by imports. And also it also implies an increase in fiscal revenues. We've seen FAC come up to 637 billion naira in the last month, and so we expect that this will continue to increase as all revenues continue to stay strong. And so this means that state governments have more funds, they can build roads, they can pay salary arrears, and the federal government, even the state government as well, can fund all their debt obligations. So this is very, very positive. It also has positive implications for the CBN external reserves. External reserves are at a 33-month high. So generally, it poses very, very, very good implications for the economy and for the commodities market at large.
I'm sure many people are smiling at the sound of that. Well, many thanks, research analyst at the financial derivatives company, Damilare Adeshola. Thank you for joining us. Well, we're staying with the commodities market, and the effect of the geopolitical tensions in the Middle East and the Korean Peninsula is also seen at the metal market as gold prices are mostly steady today. Spot gold was little changed at $1,293.24 an ounce in early trade, while U.S. gold futures for December delivery were down 0.6% at $1,295.02 an ounce. Analysts say spot gold may drop to $1,281 an ounce as it fails to break resistance at $1,305 an ounce. And in South Africa now, Simbaya-Stillwater has abandoned plans to close some of its platinum operations in the country after achieving bigger than expected cost savings from recently acquired businesses. Well, following the positive results, the company has done an upward revision to its 2017 production forecast and a downward revision to guided costs. In January, Simbaya said it might cut up to 330 jobs in platinum operations acquired from Anglo American Platinum and Aquarius Platinum. The unemployment rate is around 27% in South Africa, and the Platinum Belt has been a flashpoint of labor unrest and violence. And that's our program today. Thank you for watching INBC at Defiant.